Hi, Rick and Chuck here from Carson Choice Retirement Solutions. Welcome to the next installment of our video blog. Last time we introduced the Callan periodic table of investment returns. Today, Chuck is going to talk about how you can use this seemingly random information to your advantage.
So how can we use this random information to our benefit? The answer is, we use it to help ourselves stay disciplined and keep the emotions out of investing. And what do I mean by that? I often say that we need to focus on the things that we can control. Our costs, our diversification, and yes, our investment discipline. So what does that mean? Well, that means we ignore all the rest of the noise. Whether or not the market's going to go up or down tomorrow, which area of the market is going to be the best or the worst performer, we just focus on what we can control. Now let me show you what I'm talking about by bringing up the Callan periodic table. Alright, so let's take a look at what I'm talking about. What we're looking at here is the past 20 years of stock and bond market performance, as shown by each area of the market, or as we say, an asset class. Each asset class can be thought of as a different basket for your eggs. Whether it's large stocks here in the US, as represented by the S&P 500, or bonds, as shown by the Barclays Aggregate Bond Index, or even emerging market countries like Brazil, Russia, India, and China, as represented by the MSCI Emerging Markets Index. When you look at these columns, it's simply just ranking the best performing asset class on the top, on down to the worst performer at the bottom. So again, how do we use some of this information? Well, what we do is we take our money and we help our clients allocate it to put some of it in each of these different baskets, so your eggs aren't all concentrated in any one. And that way we don't have to predict the future. We don't have to know which area is going to be the best or the worst at any given time. Let's take a look at another example throughout history here. So let me show you how this can play out in the real world. Take a look at this period in the mid-2000s leading up to the 2008 market downturn and the Great Recession. Stocks were experiencing multi-year positive returns, and emerging market stocks were on a huge run, gaining lots of press and attention. By the time 2006 and 2007 rolled around, people heard that they were missing out if they weren't investing in these emerging market countries. And unfortunately, many investors loaded up at that point in time into a very volatile area of the marketplace. And then what happened? Take a guess. The following year, as you can see here, the emerging market asset class went out of favor and those stocks declined by more than 50%. In other words, you lost half of your investment in that area. Likewise, in the spring of 2009, when it seemed as though the global economy was crashing and doom and gloom was everywhere, no one would have guessed that the S&P 500 stocks would have had such a turnaround. And then they continued their positive performance all the way really through to this year, as you can see in the chart. So the lesson here is simple. Don't try to predict the future. Don't try to guess when to be in the market or out of the market. Use the market to your advantage. Let it tell you when it's time to sell high or buy low. That kind of discipline in 2011 would have had us sell high from our bonds and buy low in emerging market stocks, allowing us to reap the rewards of the comeback in that area. So again, let's just remember to focus on investment discipline and leave our emotions like fear and greed out of the equation. Trust me, you'll thank yourself many years from now.
If you'd like a copy of the periodic table, simply email us at learnmore@carsonchoice.com. This is Rick and Chuck. We'll see you next time.